The triple screen strategy is a very strong method that gives you an advantage over others when used properly. The basic idea is that every trade is based on analysis of 3 different charts, while each one of them represents another time frame. The system takes into consideration several technical analysis factors, and only the signals that pass the filters of all charts are the ones that chosen to be applied. This process eliminates noises and leaves you with more quality trades and higher probability to win. What you need to realize is that markets are too complex to be analyzed by one time frame and a single indicator. If you test, for example, a currency in a certain time frame, you can find the trend following indications tell you to buy into the positive momentum, while oscillators show you that the market is now in an overbought area and generate selling signals. Then if you go to another chart, let's say with a larger time frame, you can find that the opposite is true. The longer term trend will suddenly appear as a downtrend. An oscillator might tell you that it's time to buy against the main direction. The point is that the more you analyze, the more contradictions you might find. The triple screen system comes to solve it, while it combines all options and filters out the least important information. In order to determine which time frames you use, you need to first decide which is the time frame on which you are going to trade. This will be your intermediate chart, and you will use 2 additional charts, one that is longer and one that is shorter. Each one of them should be at least 4 times larger or smaller. For example, if you plan to leave your position open for at least 1 day, then your intermediate chart should be the daily chart. In such a case, your longer term chart would be a weekly chart, and the shorter term is a 4 hours chart. But because we are here to day trade, you can use the 4 hours chart as your intermediate chart. It means that you aim to keep your trade open for at least 4 hours. The longer term chart would be a daily chart, and the short term would be an hourly chart. Here is the general role of the screens. In the first screen, you determine the overall direction of the trend. In the second screen, you apply an overbought oversold oscillator, and in the third screen, you buy or sell a breakout into the direction of the first screen. And now we will talk about each one of them in more details and understand its importance and how it actually works. The chart that you start your analysis with is the long-term chart. If your intermediate chart is the 4 hours chart, then think about it that by analyzing the daily chart, you have a much wider perspective than the ones who focus only on the 4 hours chart. This chart is used for identifying the overall direction of the trend. You use basic trend following indicators such as exponential moving average and MACD in order to see where the market is currently heading. This is your first filter, and the only rule here is to trade with the direction of the longer chart. So if the trend is up, you will ignore all selling signals and only look for buying opportunities, and vice versa. The second screen is where you apply oscillators. The purpose is to identify market corrections that go against the main trend. For example, if the long-term trend is up, then you will look for buying opportunities that occur whenever the price in the intermediate chart goes down and the oscillators indicate oversold conditions. Remember that in such a case, you ignore all the selling signals of the oscillators, because again, you only go with the direction of the longer term. The third screen is used to determine the exact timing of the entry point. What you look for in this chart is an indication that the price is turning back into the direction of the main trend. If the long term is up and the medium term is down, you will look for a buying signal. This can happen in 2 main cases. 1. As soon as the price breaks up and closes above a resistance, while the oscillator returns back higher from the oversold region. And 2. Whenever a high volume bullish candles pattern occurs. Let's see an example, and this time we will use chart of Coinigy, which is the second charting platform I was recommending in addition to TradingView. This is a chart of the BTC USD. We look at the daily time frame, which is the longer chart of our analysis, and the first one we examine. We look at this area from the 6th of December and on. We see that the certain EMA slope is positive, and the MACD line also confirms that we are in the middle of an uptrend. At this point, we know that we will look only for buying signals. Now we go to the medium-term chart, which is the 4-hour chart, and search for a down movement that will allow us to look for buying opportunity. And we can see here on the 10th of December that while the price is dropping, the stochastic oscillator reaches the oversold area. At around 8 AM, it starts climbing back from the oversold area, and this is where we want to find the confirmation in the shorter term chart, where we are going to look for the exact entry point. So we go to the hourly chart, and we can find our confirmation here with the breakout of this resistance. We can place our stop level here, below the latest low. And look what happened to the price. It rose few $1,000s, and around this area we could decide to take some of the profits and let the other parts run, trying to catch even a much bigger movement. A little bit after, we had a selling opportunity. From the 20 and then 21 of December, the momentum was changed. The negative slope of the EMA and the MACD line confirms a downtrend. So now we look for a selling signal. We then go to the intermediate chart, which is again the 4-hour chart, and on the 26 and 27 we see this stochastic overbought signal. It got back below the extreme line here after 8 AM. This is when we go to the shorter term chart and look for selling confirmation. And we get it here with this red candle that breaks below this support line. Stop loss can be placed above this candle and see how great it worked. At first stage you could catch a $2,000 movement with the option to catch at least partially a bigger move of about $3,500. So this was the triple screen strategy. As I mentioned in the beginning, this is a very powerful method that can help you generate great profits if used properly. It's important that you use it with a good broker and a professional platform. In the links below you can find 2 good options for that, which are trusted and allow you to apply this and other strategies. So I invite you to check them out and register with the one that you prefer. Let me know if you have any questions. You can comment below or send me an email to the address you can find in the description. Also, don't forget to subscribe so you can follow all other strategies, reviews and recommendations. That's it for now. I'm going to see you soon.